Effective 1st April 2023, the question is whether you should prefer good old fixed deposits over debt funds. The reason being that there has been a change in taxation in debt funds and few other categories of funds, wherein mutual funds have lost their long term capital gain status. That means they're going to be taxed like your FD. So that leaves you with the question, with interest rates rising and FDs actually offering good rates, why should you even go for debt mutual funds which have not even delivered in the past couple of years? So here are some questions that we were asked, and we would like to clarify on whether tax should be a consideration for you to now switch to FDs. First thing, um, FD, the interest on FD is taxed every year. Please remember that. Even if you have chosen a cumulative deposit, you do know that it has to be declared as income accrued in the year that you're filing taxes, and that essentially means that every year there is a cash outflow because of tax on your FD. As opposed to this, with mutual funds, your redemption is the point when it is taxed. That is when you sell your mutual fund units, that's the year in which it is taxed. So it's not going to be accrued every year and taxed every year. So there is a component of cash outflow on tax that is more prevalent in FD than it is with mutual funds. So keep that in mind. So there is cash outflow for you even now in FD, whereas there is no annual cash outflow by way of taxes in mutual funds. The second point that you need to keep in mind is that FDs, the interest income that you get out of FDs is taxable. That's about it. There is no loss, and therefore there is no question of set off and all of those. However, in mutual funds, in case you end up with a loss, even though debt mutual funds or international mutual funds, other classes of some classes of mutual funds have lost their long-term capital gain status, they will still be considered as capital gain. What does that mean? That means they are considered as short term capital gain, and any short term capital gain can be set off against any short term capital loss. So if you have a gain, and for example you made a short term capital loss in stocks, you can use this gain from your mutual fund to set off that capital gain, thereby reducing your tax flows. So this is a benefit that is still available in mutual funds. Please remember, just because they have lost their long-term capital gain status, it does not mean that they have lost the capital gain status, which means set-off benefit is still available. And from the very beginning, it was not available in FD. The third thing, FD interest is still not tax efficient like systematic withdrawal plan in debt mutual funds. Let me explain this a bit. What do I mean by systematic withdrawal plan? Systematic withdrawal plan is nothing but a monthly, cash requirement that you fulfill from your mutual fund by withdrawing a fixed sum. For example, you can choose to invest in a floating rate fund or a short duration fund and decide to take a monthly of say 5,000 or 10,000 or so on, right? Now, every time you withdraw this amount, it is considered a redemption, which means there is part of it is a capital and one small portion of it is the gain. And what is taxed? Not the entire 5,000 or 10,000, it is the capital gain portion. So if for example you withdraw 1,000 every month, 10,000 every month, and say about 800 rupees is the capital gain on it, only the 800 rupees is taxed. Whereas, let's suppose you are trying to create income out of fixed deposits, and you go for a monthly payout or a quarterly payout or whatever of 10,000, same amount, the entire 10,000 is taxed as your interest income, right? So this is an inherent benefit available in mutual funds, because the sale proceed is not considered entirely taxable. Only the capital gain of the redemption amount that you make is taxable. So look at the difference. You would be paying 10,000 as taxes on rupees 10,000 in your FD, while you'll be paying taxes on say 800 or 1,000 depending on your capital gain. In fact, in the initial years of your debt fund, the capital gain proportion will be very less. Much of the component in your withdrawal will be principal, so your tax will be much lower, the tax incidence will be much lower, right? So this gives a very big advantage for income earners. I'm not trying to say that debt mutual fund should be the only source of income earning mechanism for you. It can continue to be in addition to the FDs that you hold, right? So in short, the changes made in taxation effective 1st April 2023 does not change the tax features or the tax comparison between FD and debt mutual funds in terms of, the month annual tax outgo you have, in terms of the set of benefits you have, and the systematic withdrawal plan. So tax alone cannot be a consideration for deciding that you should switch to an FD, right? So what can be the consideration to switch to an FD? Attractive interest rates, obviously. FDs can definitely complement debt mutual funds at this point in time, because a lot of banks, especially small finance banks or medium sized banks, are offering attractive interest rates. And if you're in the lower tax bucket, 10%, 20%, obviously, it always made sense to you, and now with tax parity it will make a lot more sense to you to go for those. And if you don't have any other instruments where you set off losses, like you don't have stocks, you don't have equity mutual funds, etc., then that mutual fund can't give you any set off benefit really. You can, for safety's sake, go with FDs, as long as you ensure that you're not taking very high risk or very concentrated exposure to small banks. You'll be fine. The 5 lakh insurance will ensure that your money is reasonably protected. If you want to know more about what sort of deposits you can go for, where the risks and returns are balanced, do check out Prime Deposits. I have given the link here. We will also put the link below this video. And there are many other banks that you might want to check also, if you want to see if they are of good quality to put your money in. You can find those in our FD tool, where we actually tell you our confidence level in the banks that you wish to choose in. So check both of these out, and like our channel and subscribe to our channel, so that you can benefit from more such videos.